Hello there everyone, today's video is all about capital gains tax and an interesting tax case that was in the courts recently I want to share with you, in particularly how not to do a capital gains tax calculation. So let me talk you through this scenario. So you had husband and wife and they owned a property jointly. We're going back about 5 or 6 years. It's taken that long to be finalised in the courts. And basically they had a call on a personal guarantee. So they had their names signed as a PG to someone or something, and they had to find some money, sharpish, to pay off that debt. Now, they had a buy-to-let property. So they thought, well, we're going to have to flog that. Get rid of that, pay off this obligation under the personal guarantee. Fair enough. Right. So their accountant, though, when he worked out the capital gains tax, got it completely wrong. So what exactly did he do? Well, he did this. Sales price, 400 grand of the buy-to-let property. Oh, you got the first bit right. We'll start with the sales price. Very good. Next, mortgage redemption payments, 185,000. Come off the capital gain. No. That's not what you do. But anyway, let's see what he did. And personal guarantee payment, 150,000. So he deducted that from sales price of the property together with the mortgage redemption plus some other legal expenses, and the bottom line all came out to about a 35 grand gain to Mr. and Mrs. X, split in two, something like 17 grand taxable gain. And he also applied entrepreneurs relief, or business asset disposal relief as it's now known. 10%, most favourable rate of CGT you can get. So basically, this couple flogged the property, paid off the personal guarantee, and paid less than about 5 grand of capital gains tax. HMRC opened up an inquiry and said that is not how you do it. So let's look at a couple of points. First of all, mortgage redemption. Now, mortgages never come into your capital gains tax calculation. Capital gains tax calculation is, or should be, sales price less the cost of the actual property, which I couldn't even see in their calculation, by the way, less any costs attributable with the sale and the purchase, such as SDLT or legal fees, plus any enhancement expenditure still visible in the property at the date of disposal. So if you spent 50 grand on a conservatory, but then you knocked it down by the time you sold it, you don't get the tax relief. So it's got to be still knocking about when you flog the thing. Simple, really, but you do not include mortgage redemption payments. After you've paid your capital gains tax, whatever you're left with, then you repay your mortgage in terms of thinking it that way, but doesn't come into the actual CGT. Now, this guy's accountant, Mr. and Mrs. X, should have known that. I mean, that is pretty fundamental to a tax advisor. They all know that. Now, many, to be fair to a lot of taxpayers, they may not know that, but that's why you engage the services of someone who you'd think knows what they're doing, a tax agent. But for goodness sake, no mortgage redemptions in here. Next one, PG. Quite an interesting one here. Personal guarantees. Again, payments of that do not come into the capital gains tax computation of flogging a property. However, there is another angle in the capital gains tax world where you may be able to get some capital gains tax relief for this thing here, right? So it's called loans to traders relief. And basically it says if you've lent someone a few quid and you're not going to get it back, then that is a capital loss. And you can use that loss. Now, HMRC even put forward that was probably what the taxpayer themselves were thinking about. Totally in the wrong context here, by the way. But even if they were thinking about it, the actual paying off the PG happened in the tax year following the sale of the property. So they sold the property in order to pay off the personal guarantee, but the timings were off. That this was done pre-5th of April and they paid off the PG post 5th of April, and there is no mechanism for carrying back capital losses in any case. So HMRC said, all right, we kind of see what you're trying to do here, but regardless, it ain't going to work in this context. So relief for loans to traders doesn't work in the context of this. Yes, it could have been a separate standalone calculation, but in the circumstances, nothing they could do about it to reduce the gain on flogging this buy-to-let. So an interesting tax case then, just spelling out the pitfalls of what to do, what not to do when you're calculating a capital gains tax calculation on your sale of a buy-to-let property, or indeed any asset. Don't put these in, basically. And then, of course, right at the very end, entrepreneurs relief. The tribunal found no reason at all why there should be any entrepreneurs relief. This was not part and parcel of a business other than a buy-to-let property business. Wasn't furnished holiday lets. They denied the entrepreneurs relief and said, no, it's not at 10%. It's going to be at the normal rates for residential property, which are 18% if you're in the basic rate and 28% if it trips you into the higher rate. So there you go, not 10%. So just an overview there on a recent court case which caught my attention on capital gains tax. If you like this video, please do subscribe. And as always, I'll see you soon.